Welcome back to the Tax Redo channel, where we bring you valuable insights on how you can navigate the world of finance and tax. Today, let's dive into the fascinating world of federal income tax and unravel the mystery behind this marginal tax rate. Stay tuned as we share a powerful strategy to reduce your overall tax liability. Let's get started. Understanding federal income tax is the first step to reducing it. Let's take an example. You have an income of $84,000. Many people think that this is taxed at 22% in that tax bracket, but that's not how it works. It's spread out. Instead, think of a tax rate as progressive. The government allows single people to put $12,000 in a special pocket that's not taxed. This amount can be more for couples, or if you have deductions like medical expenses or charitable donations, it'll offset it. With the remaining $70,000, we start filling up the other pockets. This first pocket has room for $9,700 and you only pay 10% on this money. Then you pay 12% on the money in the next pocket and 22% on the money in the third pocket. These are called marginal tax rates. So if you get a raise, that new money goes into the first pocket with empty space. When the space runs out, we put it in the next space. So the raise and only the raise would be partially taxed at 22% and partially at 24%. So when politicians say they want to raise the top tax rate, it doesn't necessarily mean these pockets and your money are affected. They're talking about the tax rates on the pockets way over there, which are only used once people have filled up these smaller ones. So understanding this concept of marginal tax rates can help you plan your income deductions better to reduce your overall tax liability. What this means, the government allows you to deduct certain expenses from your income before you calculate it. Now, these can include things like medical expenses, charitable donations, and the more that you can legally deduct, the less income you have to pay tax on. If you understand your tax brackets properly, you can know each item will fall within it with tax planning so that you can divide your income into different pockets and at the rate that is best for you. Now, only the money in each pocket is taxed at the pocket's rate. But if you think that you're getting close to the upper limit of that tax bracket, it might be worth your time to defer some of that income that you have into the next year when possible to avoid moving into that higher tax bracket this year. This could be relevant for things like bonuses or even freelancing. Certain types of savings accounts that you set up, like 401ks or IRAs, allow you to also defer paying taxes on the money you put into them until you withdraw it. Often in retirement at a later date when you might be in a lower tax bracket. So just remember, everyone's tax situation is different. So it's always a good idea to consult with a professional tax preparer, somebody who can plan and understand what strategy is best for you.